So, you want to build a solid financial future. Well, it's not about chasing some secret formula or getting a hot stock tip. It's actually a lot more like architecture. It's about building on a really strong foundation. Today, we're going to lay out the blueprint for a financial structure that can truly last a lifetime, using what we call the four essential pillars of investing. But okay, before we even start laying the first brick, I've got a question for you, and I really want you to think about this one. What is the single most important number in your entire financial life? And no, it's not your salary and it's not your net worth. It's something way more fundamental than that. So, what is that number? Well, it's the one that answers this fundamental situation because, look, at the end of the day, we've all got to eat, we need a roof over our heads, we've got to take care of our families. This is the financial problem, the non negotiable reality for every single one of us. All right, so let's get right into it. The very first step in any good plan is to clearly, and I mean clearly, define the problem you're trying to solve. For us, that problem is what we're calling your number. And this is it. This is your target. It's the amount of money you need every single month just to live. I'm serious. I want you to literally grab a piece of paper right now, figure out that number, write it down, and stick it somewhere you'll see it every day. Because that is the problem we are here to solve. And it doesn't just go away on its own. So how in the world do we solve for that number? It's not with some magic bullet, but with a really solid framework. I want you to think of this as the architectural blueprint for your financial house, the four investing pillars. And trust me, these have been around a lot longer than I have, and they work. All right, so here's our game plan for today. We've just defined the problem. That's your number. Now we're going to construct our framework, going pillar by pillar. We'll start with the quality of our building materials, then we'll learn to read the market conditions, then we'll build for cash flow, and finally, we'll make sure our structure is protected from any unexpected storms. And this is such a perfect way to think about it, right? Because a house with just one pillar, I don't care how strong it is, it's eventually going to collapse. You absolutely need an integrated system, a complete structure, to have any hope of withstanding the financial storms that life is inevitably going to throw at you. Okay, time to lay the foundation. Pillar number one is all about knowing your asset. This is the world of what's called fundamental analysis. And really, it just asks a very simple question. What are you building with? Are you using solid, heavy-duty bricks? Or are you using something that just kind of looks like a brick from far away? You know, what's so fascinating here is this old term, watered stock. It literally comes from back in the day when ranchers would force their cattle to drink tons and tons of water right before they were weighed for sale. Why? To make them seem heavier and therefore more valuable. In the world of finance, it means a company whose value is just artificially puffed up. It just goes to show you, trying to figure out what a company is really worth, that's not a new problem. Look, the world of finance loves to make things sound complicated. They throw all this jargon at you, all these complex formulas, but don't get confused. Fundamental analysis really just boils down to this one single critical question. Is this a strong business? Are you buying a piece of a robust, durable company, or are you just buying a ticker symbol and a good story? So what does a strong business actually look like? Well, the sources give us three fantastic guidelines. First, stick to simple businesses you can actually understand. As Warren Buffett famously says, if you can't explain it, you're just speculating. Second, look for industries where things don't change very fast. Think about Coca-Cola. Are people still going to be drinking Coke in 50 years? Yeah, probably. Will they still be using today's hot new social media app? Who knows? And third, look for what's called a moat, basically high barriers that keep competitors out. Think about railroads. The sheer cost and complexity make it almost impossible for someone to just build another track right next to yours. Now that is a powerful, durable advantage. All right, pillar one is down. You've got your strong materials. Now you got to understand the neighborhood you're building in. That brings us to pillar number two, read the market, or what's known as technical analysis. This is all about understanding the collective psychology of every other investor out there. And this is probably the best analogy for technical analysis I've ever heard. Imagine there's a contest. To win, you have to pick the three prettiest girls in town. But here's the catch. You win if your picks most closely match what the crowd chooses on average. In that game, your personal opinion is completely worthless. To win, you have to predict what everyone else is going to do. Well, the stock market, it's basically that beauty contest. So here's the big takeaway from that. Price is reality. Whatever the crowd decides a stock is worth in that moment, well, that's what it's worth. I mean, think about bottled water. When that first came out, I thought, this is insane. Water is free. Why would anyone pay for this? But then the crowd changed its mind.
It decided that convenience and purity had value, and a price was born from that belief. Technical analysis is simply the art of watching the charts to see exactly when and where that crowd changes its mind.
Okay, so we've got our strong materials, we understand the neighborhood, but what's the point of this house we're building? What's it for? Is it for a quick sale, or is it meant to generate income for you for years and years to come? That brings us to pillar 3, build your pipeline. And this is all about cash flow. When you get right down to it, there are really only 2 ways to make money from an asset. The first is called capital gains. Think of this like flipping a house. You buy it low, you fix it up, you sell it high, and hopefully you walk away with a big, one-time chunk of profit. The second way is cash flow. This is like buying that same house, but instead of selling it, you rent it out. Now you're getting a smaller but steady and continuous stream of income month after month. One of the absolute best ways to understand this comes from the parable of the pipeline. So the story goes, there's a village that needs water. 2 guys, Ed and Bill, they get the contract. Ed immediately grabs 2 buckets and starts running back and forth from the lake, hauling water. He works his tail off and he gets paid for every single bucket he delivers. If he stops hauling, the money stops. Meanwhile, Bill disappears for a while. He comes back months later with a whole construction crew, and he builds a stainless steel pipeline from the lake straight to the village.
And when that pipeline is finished, clean water flows 24/7, and Bill gets paid for every single drop, whether he's working, sleeping, or on vacation. So you really have to ask yourself, is your financial strategy based on hauling buckets, or is it based on building a pipeline? Assets that produce cash flow, things like dividend-paying stocks or rental properties, those are your financial pipelines. They're designed specifically to cover that essential monthly number that we started with.
All right, your house is up, it's generating income, you're feeling good. But we all know storms can roll in, right? And that brings us to our final and absolutely crucial pillar, expect the unexpected. This is the science of risk management. And in the investing world, these storms, they basically come in 2 flavors. First, you've got systemic risk. This is the big one, like a recession or a major market crash that affects pretty much everyone. You can't really hide from it. But then there's what's called non-systemic risk. This is a problem that's specific to just one company. Think of fraud accusation, a failed product, or some kind of catastrophic accident. One of the sources shares this incredible real-world example of this. Remember the year of the Deepwater Horizon oil spill? The company, BP, British Petroleum, their stock got cut in half. It went from $60 a share all the way down to $30. It was an absolute disaster for anyone who owned only BP stock. But you know what? It was just another Tuesday for shareholders of Coca-Cola. That right there is non-systemic risk in a nutshell. And it's exactly why the oldest advice in the book is don't put all your eggs in one basket. And that just brings us full circle, right back to our house. A truly strong financial house requires all 4 of these pillars working together. I mean, if you only look at the fundamentals, but you ignore what the market is doing, you might buy a great company at a terrible price. If you only chase cash flow, but you don't actually understand the business you're buying, you might end up with a pipeline that's about to rust through. And if you do all of that without managing your risk, a single broken pipe can flood your entire portfolio. So, as we wrap this up, I want you to take a moment and really think about your own financial house. Does it have all 4 pillars? Is each one strong and stable? Because that structure is only as solid as its weakest point. Take a real honest look and ask yourself, which pillar are you going to build next?